Hey Shane, how's it going?
Dude, it's good. It's good. I was just laughing at the Babylon Bee daily email, just full of dynamite, pure gold headlines today. So no shortage of fun stuff to choose from. Pretty cool.
It is. And we're doing something a little different today. So it's January 11th. We usually would record on a Thursday, but we're busy. And wouldn't you know, the CPI number is coming out tomorrow morning. So it'd be interesting. But let's go ahead and
Yeah,
get right.
it'd be much better to be recording this tomorrow once we have the CPI number. But instead, we'll get to play a little bit of a speculation game maybe and see who can guess the closest or something like that. Maybe if some of the viewers want to send in some guesses. I don't know though. Probably by the time we post this, the CPI number will be out, so we can't really play the game with viewers.
Yeah.
I doubt you're
It,
going to be able to post it tonight, right? You're going to do this tomorrow.
oh, no, we can post it tonight and I will.
Hmm.
So
All right.
it'll be up tonight. This is Wednesday, but people can watch it, kind of see what we think ahead of the report. So
Well, if you watch it tonight and you want to guess, shoot us a guess, and if somebody gets real close, we'll send them like a hat or a t-shirt or something.
sounds good. And for anyone new in this channel, we just cover markets. So, individual stocks, kind of macro, all that, and just try to, I don't know, help you and us kind of find our way through everything. So, why don't we go ahead and just turn it over here? So
Let's
I'll
rock
share
and
my
roll.
screen.
And you got a hard stop coming, right? You got the meeting coming up, so we gotta.
So here we go. Let's get into it. We got our legal disclosure. People can screenshot that and read it if they feel so inclined, but this is a big one. So just hit on quick. It's always the question, well, it's a bear market. Why should I invest? And there are a lot of industries that are above the 200-day as well as a lot of other averages, but you can go in here and why try to bottom pick? So you've got industrials looking pretty good across the board. And why? I'm no expert in that, but the market's telling me there's an uptrend evolving or in place there. And we can talk about some of that. And then you've got energy still looking pretty good, but key point, if you just want to go buy something long term looking pretty good, just start with a trend. If it's making new highs, if it's above averages, those are good. And on that note, here's new 52-week highs.
Yeah,
So,
the industrials probably look good because Caterpillar's in there, right?
yep. So Caterpillar, new all-time high. And Shane, you and I don't agree, but if I don't use my brain and I go with the trend, I like Caterpillar. It's hitting a new all-time high coming out of a consolidation. But this would not be a bad list to go through if you're looking for something to add to your portfolio in this bear market. What's still doing well. It can be that easy. These are the leaders, so go look at those, look at some fundamentals, and maybe you'll find something. But big thing, CPI is tomorrow, and what is the overall market going to do? So, Shane, I'll let you start. I think I know what you're going to say, but um, you've drawn a nice chart, and there's a lot of stuff right above this candle.
Yeah, we'll see. Market's trying to rally. You can see what happened after the last CPI report, which was followed the next day by a Fed meeting. Market dropped like 6, almost 7% in pretty short order right after those, even though things were looking really, really bullish above the 200-day moving average and, lots of momentum going that way. So, last month, that was, I guess it was December 13th. And CPI was on the 13th, I think, and then the Fed meeting was on the 14th, and everybody was as bullish could be. And of course, nothing happened, but a whole bunch of selling off the next couple of days. And I really don't expect much to be different this time. We don't have a Fed meeting until February 1st, but I would expect that CPI will come in tomorrow with a six handle, whether it's 6.1 or 6.8 or 6.9. I have no idea. I don't really care. I know that a six handle is not going to lead to the Fed cutting interest rates or pausing their rate hike cycle. So Fed's probably going to be hiking rates February 1st. CPI is probably going to come in with a six handle. If it comes in over 6.5, which is what the market expects on average, the consensus is 6.5. If it comes in higher than that, the market will go straight down. Like it won't even try and rally in the morning. It'll just go straight down, tank city. That's what I would expect.
Yeah,
Um, if CPI comes in less than 6.5 or at 6.5, I would expect a little bit of a rally in the futures. and then probably a sell-off, just like we saw last time when the reality sinks in that like, yes, 6.2 is better than 6.5, which is better than 7.1 or whatever it was last time. But it's still not, I mean, we're literally talking about 6% inflation year over year. It's not 2%, which is what the Fed wants it to be. And the way the Fed's going to get it to come down is by hiking interest rates. So, I don't know. They're not going to cut interest rates. The only way the Fed's going to cut interest rates in 2023 is if the whole economy melts down. The stocks have to go down 20 or 30% more from where they are today to bring out the Fed cutting interest rates is my personal opinion. So I don't see any accommodative monetary policy on the horizon right now. They need to squash inflation, and arguably they haven't even had a big impact yet. So
Yeah. And I know one date where they could cut interest rates, and that would be April 1st. So that would be a really mean joke to pull on that day. But I'm with you. They're not going to be cutting, so I wouldn't be banking on that. But when I look at this, so this candle or chart doesn't show the overnight trading that took place, but when that last CPI report came out, it just kept rallying all throughout the night up to the report, and it got really overextended. Came down, Fed followed. When I look at this, so I've said it before, guilty till proven innocent. We are still under this, but you want to think about, investing, trading, what have you, as risk reward. And right now, the fact that it got overextended today, going right up into here, if I was going to place a bet, I'd be placing it short. I
yeah,
wouldn't be the least bit surprised, like you're saying, Shane, to see this just totally get erased after tomorrow.
that's
But
my expectation.
we'll see. I think when you look at it, it's simply once we clear over this, consolidate and wants to go, great. Maybe there is a bull market and we need to evaluate some of the stuff that's out there. But right now, it's still under that trend line. It's right up into a place where, you're risking a very small amount right here, just that line, to end up right back down here, maybe all the way back down here. So we'll see what happens. And the other thing too is first 2 weeks of January, historically, usually pretty bullish. So I
Yeah,
think that's, the January effect.
market's full of optimism, clean slate. Everybody's going to be healthier this year. They're all going to lose 100 pounds, and they're going to improve their relationships. Everything's going to be perfect in
Yep,
2023 for at least the first couple of weeks, and then New Year's resolutions begin to fail, just like the stock market.
yep. So not looking too great. And then here's just another way of looking at it, just some of the levels we've been watching, everything.
Well,
But
to be fair, this, I'm often wrong. I say it all the time. I'm wrong way more often than I'm right. The idea is to lose only a little bit when you're wrong and make a lot when you're right. And so, last week I said, this pattern, that pennant sort of pattern, that we were in between those two purple lines there, because we had come down before into that pennant, probability suggests that it would break lower out of there, and it did break higher. So that's I was wrong on that pattern, but thankfully I wasn't long a whole bunch of SPY puts that expired last Friday, and so I live to fight another day. But yeah, being wrong is just part of the game. If you can't handle being wrong and trading or investing, then it's probably not something you should do, because you'll be wrong a lot. And the whole point, like I said, is to cut your losers quickly and keep the winners for a long time. So that would have been a loser if I was actually in a trade based on that call. And thankfully I wasn't, but I did want to own that I did say that on this call last week, and turned out to go the other direction. So that's
yep,
but I mean, ultimately, just like the chart we just looked at of the index itself, this is the SPY, the exchange traded fund. It just keeps making highs. It rallies into lower high, rallies into lower high. I mean, there were at least 3 bear market rallies last year in 2022, all of which failed and ended up making a new low. One of them was 12%, one was 19%, one was 17%. And it's demoralizing to think that, the bottom is in and you're up 20% from the lows, and then boom, you roll over to a fresh low. So we're getting closer to the end, but I don't think we're quite there yet.
and I agree with you there. And just to hit on the point you mentioned, when you're wrong on a trade, the way to make money is to go in with a plan of what you're going to do when you're wrong. That's how you make all the money in the world trading is what do you do when you're wrong? Because everyone usually goes in with bright-eyed optimism, buys something, they think it's going to the moon. They're right maybe once, maybe twice. And then finally, when it doesn't work, they'll blow up their entire account. So, the big thing is what do you do when you're wrong and keep those losses small? And that's a perfect example. So,
Yep.
and now here we are, NASDAQ. It looks like it's trying to find a bottom, but kind of goes back to the same thing for me. Big picture, it's just still in a downtrend. And right now you're rallying right into the 50-day, which now it's a flat 50-day right here. So it doesn't seem as strong to me. It's not trending quite as much, but you could definitely see it just consolidate right here and then make a real big move down, or it could go up. So we'll see, but I'm voting for down.
Yep, not much to see there. Just in a long-term downtrend, so can be a lot of noise in between there and in a bottom and a breakout. So yep, I'm not I mean, don't get me wrong, you can go long this kind of stuff if you want to play a run up to the 200-day moving average or something. I mean, it could absolutely rally tomorrow, depending on the print. So not saying that can't happen, but I don't know. I got my bear goggles on, man. I see everything bearish. I see the fundamentals behind it, and I'm just not super optimistic for upside right now.
Yep. And then Apple. So here's the darling, and look at this. So it's bouncing up. It's going right back up to this point of resistance that has been hit so many times now. That to me, I saw that and I thought, what a perfect move. You could have the Fed push it right up into this 138 level, fail, and then make that next leg lower. What are you seeing?
Yeah, I'm just interested to see what happens if it gets up to 138 again and what happens from there. So I definitely expect that to be some resistance. So yeah, I'm just interested to see if that 138 level, blocks a run higher. But yeah, that's it. That's the only reason I put it in. So we'll keep our eye on it and see if we get to put another little red circle on there.
Sounds good. And then turning to oil, the chart that used to look so good. So last summer it was just great. Everyone swore it was going to $200. I thought it might try to make it somewhere near there. I didn't know if that was going to be the number, but it did look good. But now it's just back under this, I guess, shorter term line you did. So the year-end high of about $80. It's going to come right up into that. We'll see what happens from there. I don't know the fundamentals well enough to really weigh in, but still
No, but
just kind of chopping.
I see a flip to green on the MACD down there at the bottom. So
Mhm.
the moment that to me that it made a higher low over the past few days, and quickly flipped negative momentum into positive momentum. To me, that I'd be pretty optimistic if I traded this. I'd be willing to go long here. Maybe even just like a partial position size and see if maybe I get lucky and it breaks out above that trend in the 50-day. But there's a lot of overhead resistance, so I certainly wouldn't be getting aggressive about buying it here. But I do think I think that fits the look of something that I might be interested in taking a stab at on the long side. But there's just a lot of overhead resistance to get through before you're kind of like free and clear to run much higher. So you don't need to pick bottoms. There's lots of other charts out there that you can buy if you want to express a bullish opinion and you want to go long something. So I don't think this is a best bet, but I would not be surprised if it's done going down, just because the federal government has to replace that SPR, the Strategic Petroleum Reserve, and they said they want to do that around 70. And I mean, you look here, it's holding 70
Yep.
because we know that there's a buyer there. So we'll see what happens. One of my buddies was talking about some options that the government has expiring in February, and so them needing to take some action sooner than later. But I don't know much about that. It's just something I heard, may or may not be true. But anyway, maybe we'll see some activity. But I heard the government has not bought any oil yet for the reserve. So that surprises me, actually. I figured they would have at least bought a little bit when it hit 70.08 down there a couple weeks ago. So
I agree. And something I just want to hit on, but when you do trades like this, that's where you don't have to buy it all at once. So you could just get a starter position. So maybe you're going to risk $100. You start at 25 down here. And if it confirms and gets above there, you can buy a little more and ride it up. That keeps your downside limited, and overall your return profile looks pretty good. You're risking
That's what
less
Jesse
initially.
Livermore
And
would do.
yep. So not a bad way to do that, or in a bear market, if you're gonna pick a bottom, just risk less when you're trying to do it. Start with a small position, and if it confirms, now you're in and you can add to it. So, and now this is just the bearer of bad news right here. There's no way to spin this positive. I mean, as long as I've been in finance, I haven't seen charts like this, but inverted yield curve like no other. Last time we saw it was in the 80s. This is just bad.
Yeah, 63 below zero is pretty cold. So that's a cold economy, man. I don't know. I wouldn't want to be getting too optimistic about anything on the bull side. Or probably heading into a recession. It's probably, well, I don't know. It could be ugly. You just never know. And so I'd be cautious for sure, just because of that. So in the
Yep.
long run, I think we're heading to a recession.
And something too. So this is one of the best fundamental indicators, and this can happen. It doesn't mean the stock market's going to just crash right now. It might take some time for it finally to feed through and people finally give up and they say, hey, it's not crashing right now. Maybe it is time to get in.
Yeah.
That's about the time where it finally breaks really hard, but that's just not something you want to aggressively go buy stocks with when you've got a fundamental indicator acting that poorly.
Yep.
So, and then here's the US dollar. We were talking, this looked like
Fail.
it was going to go, but
Just
I,
a fake out, man.
yeah, you know what it looks like to me right now is that breakdown right here. The last 2 days, you got some inside candles. That looks like it's just getting ready to break right down with a nice big candle, maybe tomorrow.
Certainly could, man. I don't think there's a lot of edge there one way or the other. I don't like that the momentum is the way the momentum looks. It looks to me like it needs to at least go sideways, or even lower, for the next few weeks before it can build any real like, like kind of coil up the spring so it can actually go higher again. I don't know. I don't see the dollar going higher, which is good for stocks. I mean, the lower the dollar goes, the better it will be for stocks. But it's counterproductive to inflation, right? The lower the dollar goes, the more dollars things cost, which means price inflation goes higher, which means the Fed needs to raise rates more. As the Fed raises rates more, that will cause the dollar to go higher. So everything's interconnected. And the dollar here, I don't know. I don't really trade it anyway. There is a fund, UUP, I think is that right? UUP is the dollar fund, I'm pretty sure.
And you can always also,
Yeah,
so this is
US
the
dollar
dollar.
bullish,
Yep, this is
UUP,
also the dollar against a basket of currencies. So
right?
if you want, you can, if dollar's going higher, well, then maybe you short the Japanese yen or the Aussie dollar, or,
Or the
there's
euro.
a lot of options out there. So,
Yep. Yep.
and then mortgages. So I'm liking that, houses are coming back a little bit, but this interest rate here looks to me like it's just a little bit of a dip here, wanting to go higher. And Shane, you and I talked, we don't have updated data for today. They
Yeah,
don't
that's why I
update
went
it.
with the trading view chart this week, is because we didn't have the current day data. Freddie Mac updates the mortgage rates on Thursdays, and of course we normally record on Thursday afternoon, and it's now Wednesday evening, so we don't have tomorrow's data. I'd love to do that. I'd love to get tomorrow's data just once in my career. I would be able to retire hopefully the next day. But anyway, we'll get the new mortgage rates tomorrow, and we'll update you guys next week. But because of that, I thought I'd just go with the trading view chart, which has last week's data. And you can see the meteoric rise. And you can see all the way back to 1984 how high interest rates used to be back then. And could be a lot longer to go here on the upside, even though rates have pulled back from over 7% to 6.5%. Could just be a minor pullback within an overall long run higher. So we'll see.
That it could be. So, the next thing on the interest rate stuff is a lot of credit card balances are going up, and you can only roll your balance so many times before finally people stop paying. But what'd you see
Yeah,
in this?
I mean, on the left hand side, I've got some text there. It's just starting from the bottom. Currently, the average credit card interest rate is 20.04%. That's like a record high, for as long as we've kept the data. So if you carry a balance on your credit card, right? If it's $1,000 that you carry on your credit card, uh, you're gonna be paying $200 a year to maintain that $1,000 balance on your credit card.
And it
That's
compounds, so it's
that's
1,200 the
crazy.
next year.
Yeah,
1,200 times 20%.
it's amazing how much interest that is, and how like at the end of the year, you'll look and you'll find out that, like, you know, you're spending some thousands of dollars just in straight up interest payments, like thousands of dollars that you could have spent on a vacation or something else. And I'm guilty. I used to do this. There was a time in my life where I carried a credit card balance. I mean, it's not that I didn't know what was going on, but I didn't recognize how much actual dollars it would cost me, you know? And then once you figure it out, you're like, oh my gosh, I'm never going to carry a credit card balance again. Like, if you can't afford to pay off your credit card in full at the end of the month, you can't afford to buy whatever it was you put on that credit card. That's just how it is. And people use credit cards to, you know, effectively live a lifestyle that they probably can't afford, um, all the time, and it gets them into a lot of trouble in the long run. And so if that's you, I promise I'm not picking on you. I mean, we have super wealthy clients. Uh, they make a lot of money, they have a high income, they spend a lot of money, right? And many of them, I shouldn't say many, some of them still don't understand. And they're like, hey, I've got a balance on my credit card. I mean, Kyle, this has happened to you a couple of times recently where
It
it's like, hey,
has.
I have a you tell a story. They're like, hey, I have a balance on my credit card. I'm carrying a balance, which means I'm paying this 20% interest. And maybe they're not paying 20% because they have a good credit score. And so maybe their interest rate is only 15%, but still it's obscene. And it's like, if you're carrying a balance and it's costing you 15%, and some of your clients they're paying down, making extra mortgage payments.
Hmm.
So even if we went back to the mortgage screen, we don't have to, but if the mortgage rates are 6.5%. So even if you had a brand new mortgage and you're paying 6.5% to have that money, it's like, which one do you think you should pay down more aggressively? The one that costs 15% or the one that costs 6.5%? And it's not, for whatever reason, it's not immediately obvious to every single person out there, even very intelligent people, what they should do. So what should they do, Kyle?
So I think a lot of times when you look at it, just take that number, whatever the interest rate is, and think of it like an investment. So
Yep.
given the option of a 24% return on an investment or a 6 or 7%, which one do you choose? I'm going with that
The higher one.
24%.
I'm going with the higher one every time. Yep.
Yeah, especially if it's guaranteed, which means, you know that if you don't pay it off, you are going to pay 24%. So great place to put money, get that thing paid off. And then the other one too is there an asset that backs it? So, credit card does not have an asset behind it, but a mortgage does. So at least since you have that debt on that house, you still own that asset that can appreciate and offset some of that cost. Whereas just
Mortgage
straight
interest is,
debt,
oh, sorry, go ahead.
oh yeah, just straight debt without anything backing it, as an asset backing it, you're just sitting there paying money to a bank and nothing's going up in value.
And correct me if I'm wrong, but mortgage interest is still tax deductible on some basis, right? Like up to some
Oh yeah.
limit. So like, even if you have like a $2 million house, like the first up to 500,000 or something is tax deductible. I don't know how it works. Maybe you don't either, but they change
Yeah,
they
it's
change the stupid rules all the time. I don't really
it's
know.
kind of if you have enough mortgage interest, not on $1 million mortgage, you're not getting that break. But if you have a mortgage and then you itemize and those total more than your standard deduction, then you can use that to offset your income. But with the standard deduction being increased when Trump came in, kind of made it where a lot of people just use that standard deduction. So
Yeah.
they ended up not getting that mortgage.
Well, just to wrap up, I mean, if you're carrying a balance on your credit card, you're not alone. Apparently 46% of credit card holders are carrying a balance from month to month on at least one of their cards, and a lot of people have more than one card, which I'd say cut it down to 1 and don't carry a balance. That would be my advice to you. If you want my advice, that's what it would be. But these people are going to be in trouble at some point, and I don't know. I don't see a lot of help coming from the Fed. So
Yep,
we only have like 5 minutes left. We got to wrap this up, right, Kyle?
that's true. So
So we better
let's,
well, let's just do it real quick. This is a sequence of returns risk, and I wrote about this in my recent market commentary. So if you want to dive a little bit deeper into this, you should go to our website, click on market commentary, and read my current commentary. But um, all this is somebody starting with $1 million, taking out 5% per year, adjusted for 3% inflation. So it goes up. You start with taking out 50 grand a year and increase that by 3% each year. You start with $1 million and you earn an average 5% rate of return. So if you're taking out 5% and you're earning 5%, you would think that at the end you have roughly the same amount of money. Well, the order in which you get the returns that average out to 5% is of very, very high importance. On the left-hand side, you see that that portfolio, it gets an average rate of return over 20 years of 5%, but early on in the first 4 years, the returns are all positive before its first down year. That portfolio finishes the 20-year period with 812,000 bucks still left in the portfolio, and they've taken out $1.3 million over the term. So that's a good outcome, right? So if you were, let's say you started that at age 75 and you live till age 95, you die and you leave 812,000 to your family, and you were able to take 1.3 million out of it during your life. That's a pretty good outcome. But for the same person, say they're age 75 and they retire in 2008 or 2022, and the very first year the market's down 25%, and then the year after the market's down again. And meanwhile, you're taking out the exact same withdrawal amount, 50,000 the first year and 51,500 the second year. This portfolio runs out of money in 15 years. And after only spending 929,000, not even the full $1 million. So the big idea here is that if you take your money out too early in a down market, those dollars, those investments are not in your portfolio to recover when the market ultimately comes back later. So a systematic withdrawal plan directly out of your investment portfolio is absolutely financial suicide, and we would not recommend it. So I know we had to cover that pretty quick, but you can pause it and study and go read my commentary if you want some more color on that. And maybe we'll come back to this topic in another call.
yeah, I think that'd be good, especially in this
Anything to add
market.
there, Kyle?
No, just the main one there is having an adequate cash buffer. So you want to pull from cash and have it be a sufficient amount that when this year happens and your portfolio is down 25%, that you don't have to draw out of it.
You don't have
So,
to sell stuff in a down market. That's right.
yep, that's the key. So, but what's knocking this
Oh,
market down?
back up one. Back
Oh,
up one. I want to make sure people get this. So,
oh,
we got the arrow there. All right. So this is the consumer price index. When people talk about CPI, even when we talk about it on this call, we're always talking about it in terms of a percentage. And the percentage that we give is generally the year over year change in the CPI, the consumer price index. But the index is just a price, just like the S&P 500 index is just a price, right? It's a number. In this case, the CPI number is 297.711, and the month prior was 298.012, and the month prior was 296.808. And what we do is we calculate, what was it a year ago, and determine a percent change. Well, if you look at this chart, you could see that the CPI started going up in January 2022, and it went up a lot, and then it flattened out by the middle of the year 2022. So CPI has basically been flat for 6-7 months now. Yet the year over year change is still relatively high. Go ahead and go forward, Kyle. But this is how it looks on a percent change basis. It looks like it's coming down, right? It come down from 9.1% to 7.1% last month. And it looks like that, those two charts look totally different. But they both tell the truth. So which one is more important? You can be the judge of that. But again, the whole point here is that a 7.1 or even a 6.1% rate of inflation is incredibly high and things are incredibly expensive. And that inflation is remaining sticky. So just because, inflation didn't go up by 9% last month from 1 year prior doesn't mean that prices aren't incredibly high right now. And that's really not changing. Prices are not coming down. They're just not going up by as much.
Right.
So be careful when you have somebody tell you that inflation is coming down. It is not. It's just not increasing by as much. And this is a very good reflection of what are called base effects. The only reason that the consumer price index year over year percent change is coming down is because the base number, the starting number is it continues to step higher. And as that happens, it's harder to continue the same rate of change on a year over year basis.
Yep. So thanks for bringing that up. So if you want to play around with the numbers and kind of mislead people, you're going to want to talk about that, percentage change, and not really the best way to go. So, but
We'll just rip through this. These two Fed presidents talked recently. Both of them are looking for interest rates above 5%. We are not currently above 5%. So the only way that the Fed funds rate can get over 5% from where we are now is if they hike rates by more. So they're not going to cut rates, and they're certainly not going to cut rates when inflation is over 6%. We need to get to 2% before they ever think about cutting rates again, I think.
yep.
So
So
these are both hawkish.
both hawkish. So, and then Shane, the most important slides of the day. This one, a lot of talk about gas stoves getting
We
taken
left it
away.
in. I love it. Go ahead.
So people, I'm sure anyone reading this kind of gets it, but yeah, eggs and bacon getting expensive. But if you don't have a gas stove, they won't taste as good and not so great. And then
Hilarious.
just here's another one, but check out this chart on eggs. That's the real chart. This is not a joke. It's from the St. Louis Fed. Eggs are getting really expensive.
And that's
So
in dollars. That's not even in percent change terms.
yeah,
Look at that. See, it's in US dollars. If that were in percent change terms, it would be like 20%. It's crazy. Or no, more. I mean, my goodness, that's a lot. I don't know. I guess it goes back a couple of years though too. So that's yeah, I don't know. Somebody on Twitter, some CFA charter holder, I don't know. I'm not on Twitter, but I saw the tweet. It said eggs are the new Bitcoin, and I thought that was hilarious. Looks like the old rocket ship we used to draw. And of course, the Babylon Bee has had a couple of great headlines. Man, everyone mocked for raising chickens gets the last laugh. And Scrooge McDuck. I don't know if you guys remember DuckTales. I used to watch that when I was a kid.
oh yeah,
That is normally him diving into a whole bunch of gold coins. That's what it normally is. But instead, he is diving into the eggs, which I guess is going to get messy. I don't know why you'd want to
they
ruin your
could be
eggs.
hard boiled. So that's the hope.
Oh, that's hilarious. All right, man. We're 2 minutes over time. I know you got to run to a meeting, so I guess we'll leave it there for now, and we'll see you all next week.
Sounds great. Thanks, Shane, and everyone. Love having you watch, like, subscribe. Let us know if you want to see anything else. So until next week, have a good one and good luck on CPI tomorrow.
Thanks, man. See you.